We're here to talk about Silicon Valley real estate market and then the Greater Bay Area, 13 counties. This week, number 16. We'll come back to these URLs at the end. I'm Richard Calhoun, Creekside Realty, working with buyers or sellers here in Silicon Valley since 1981. Here are some of the things that distinguish my statistics versus other statistics. We'll go over this in detail at the end out of courtesy at the time of repeat viewers. This is a new table, and it's one that I'm hesitant to put in, but it's some of the major sought after school districts and what the market conditions are. My hesitation is school districts often are not large enough, and this isn't even all the school districts, to be statistically significant and gives you some bad data, but it used in conjunction with the balance of the data, I could see it being useful. So I'm looking for feedback on whether people want me to develop this or drop it. Here is the first normal data slide. What we're doing is we're comparing today's current active listings versus the 10-year median for the same week of the year. My year begins on March the 1st of every year, goes forward 7 days at a time. When we get around to February 21st, I jump forward 8 days back to March 1st. On a leap year, I jump forward 9 days. So I have one discontinuity, which is why I have my statistical fiscal year starting on March 1st of every year. Basically, we have a limited inventory. We're below 100% in most of the areas in Santa Clara County. San Mateo County is probably a little closer to 100%. A lack of inventory is shaded red in color because that would favor the seller. It's a more competitive market. So Santa Clara County is sort of the reddest. Alameda County has a uniform pink color, which is lighter than Santa Clara. And San Mateo County is the lightest, which means it has the most normal inventory. Now we're flipping over and looking at the buyers. How many offers were accepted in the past 5 weeks? Here, again, we have a shortage of offers, and a shortage of offers compared to the 10-year median is a cool marketplace favoring the buyers, and that's why it's blue in color. It favors the buyers. Basically, you can see the outlying areas have fewer offers. Sort of the Mountain View area's got them right at normal offers, and San Mateo County is typically closer to the normal number of offers in Santa Clara or Alameda County. But now we look at the balance between the two, and this is the more important of the three numbers that we've gone over so far. And this is the balance compared to the 10-year median. A low number here is a faster market. A number like in Milpitas at 102% is slightly longer marketing time, slower market time. And where you really have slow marketing times is in San Mateo County on the coast at 150%. So 50% slower than it typically is. Atherton, the expense varies 70% slower. Los Altos, Palo Alto, 23% slower. North San Mateo County, 28%. The rest of San Mateo County is right at 100%. Most of Santa Clara County is just under 100%, with the fast areas being Saratoga, Las Gatas, and Cupertino, Sunnyvale. Here, again, the lower the number, the faster the marketplace. The slower the number, the cooler the marketplace, which is why the blue color. Cool marketplace favors buyers, hot marketplace favors the seller. Now we're getting rid of the 10-year comparison, and we're simply looking at days unsold inventory now. This is a theoretical number of how long it would take to sell the existing inventory at the existing rate of sales if there was no new inventory and the existing rate of sales stayed constant for the period of time. You can see Santa Clara County is right around 20 days. Some areas a little bit higher, some areas a little bit lower. The expensive areas are clearly slower, almost double that at 40 days of unsold inventory. Then you go into San Mateo County first, and it's more like Santa Clara County, maybe a little bit higher, 22 days, maybe something like that. And then Alameda County is right there, sort of like with Santa Clara County. Again, the red colors are the hotter marketplaces, the blue colors are the slower marketplaces, and the white colors or the no color is basically a balanced marketplace compared to my standard, which is less than 6 weeks is red in color, more than 11 weeks is blue in color. This is the first data slide that might be easier for the lay person to understand. It's simply the long typical time of what sellers are taking to sell their property. Statistically, it's the 75th percentile. So 3 out of 4 sellers are selling their home in less time than shown here. And 25% or 1 out of 4 sellers is taking longer. And Santa Clara County is probably right at 10 days. You go up into San Mateo County and it's a little bit more varied, all the way up to 50 days on the coast. A lot of the areas are right at 2 weeks. And you come back to Alameda County and it's probably right around 12 days. Then you look at sellers' ask price reductions. This is what I call a very tight metric. And the reason for that is the vast majority of the sellers don't have time to do a price reduction. And partly that's because they come out and they do their research before they list their home and hopefully don't have to do price adjustments to get the home sold. You can see in 2 areas in Santa Clara County where prices were actually raised. That does happen. The 2 primary cases is where someone came out and priced their property at $999,999, trying to say under $1 million, even though it was worth 1.25. They didn't get the offers for whatever reason, and now they want to get back up to close to the market value. Another example would be a seller that came on the market was actually flooded with unexpected interest, so they raised the price, to decrease, throttle back some of the excitement. And there's also some agents that will raise their price after they get the offers accepted, concerned that if the appraiser sees the low listing price, they will appraise the property for the listing price and not the actual market value. Whether any of those have merit or not is a whole nother discussion, but it is possible for sellers to increase their price. Most of them are slight decreases, and again, the reason they're so small is because the vast majority of the sellers make no price adjustment whatsoever. You can see the biggest reduction is 4% on the San Mateo County coast. Now what we're looking at is the frequency of those price reductions. So how common are those price reductions? And basically anything under 17% is going to be somewhat of a hot seller's marketplace. And you can see most of the areas are single digit as far as the percent of sellers reducing their price. The slowest one, again, is the San Mateo County coast, the most frequent. So 1 out of 5 sellers reducing their price. This is the magnitude of overbidding. So now, and the advantage of the numbers that we were just discussing is you don't have to wait for escrows to close. You can see what's happening to list price when that offer gets accepted. So is the list price being reduced and how much, et cetera. So you don't have the lag time of escrow. Flipping over and looking at the offers accepted, you now do have the lag time, and but it allows you to look at what the buyers are doing on the offer price versus the seller's ask price. And you can see in Santa Clara County somewhere maybe right around 10% overbid. And so if a seller's asking $1 million, then it goes for $1.1 million. In San Mateo County, you got a reduction of almost a full 1%, 0.8% on the coast, to a high of probably 9% positive in Redwood City. Clearly lower magnitude of overbidding than in Santa Clara County. The Santa Clara County goes all the way up to 15%, and the lowest number I'm seeing in Santa Clara County is a 3% price increase, where the San Mateo County coast goes from basically a -1 to +9. And you go into Alameda County, and Berkeley and Alameda have the biggest price increase at 15%. Oakland is sort of a tale of 2 worlds because it's got a 12% increase of overbidding, but yet a lot of their indicators are a fairly slow marketplace in Oakland. So you have a slow marketplace with overbidding occurring. Fremont at 12%. Alameda is probably very similar, if not maybe slightly outperforming Santa Clara County as a whole on the amount of overbidding what buyers do to try to get their offer accepted. This is the frequency of overbidding. How common is overbidding? And you can see that the slowest area or the least area is San Mateo County coast, with 25% of the sellers getting overbids, which means 75% are not. But you flip that around and you come into Campbell, Cambrian, Santa Clara, and Willow Glen in Santa Clara, and 87% of the sellers are getting more than their asking price. You go down into Alameda County, 87% in Fremont. It's clearly a very aggressive marketplace anytime you're above 80% of the sellers getting above their asking price. Here's the appreciation since the last 9 months of 2015. I was looking for a full year with stable prices, and the 9 months of stable pricing was the most I could come up with. The areas here, color doesn't have anything to do with market conditions. but blue is the area that has the least amount of appreciation, which would be reflective of a cool marketplace. And the red areas have had the most appreciation. And again, that's just the last 3 quarters of 2015. So you can basically see the peninsula has some of the least appreciation. And then the east foothills, the cities along the east foothills sort of have the most appreciation, as well as Pleasanton. Livermore used to be up there, it dropped down this week, and there is a little bit of weekly fluctuations. Here we're looking at the sold price, and instead of just looking at the median, which is the middle number, I sandwich it by looking at the lowest, the most affordable 10% and the least affordable 10%. So in South County, for example, you know roughly your price ranges from $890,000 up to 2.4 million, with 1.3 million being the midpoint. And you can see from 900,000 to 1.3 million is only $400,000 increase, but from 1.3 to 2.4 is a $1.1 million increase. And that's just the nature of real estate. The bell curve is such that when you're in the lower price range homes, the homes are spaced closer together. So you don't have to go up as much dollar amount to get a set increment like 40%. But once you hit the median and now you're going for another 40% increase, which is from 50% to 90%, the dollar amount is much greater. In fact, it's what 3 times if I'm doing my math right. The huge advantage of this, if you're looking for a number below, if your affordability is below the left-hand number, the cheapest 10%, the chances of finding a home in the particular area, micro market area you're looking at, becomes that much smaller. You could find it by buying a busy street, backing up to a freeway, backing up to a school or a shopping center, being on a busy street, those kinds of things, a fixer-upper, but it gets harder to find a property that if you're at or below the 10% number, and that's why I went out to the extremes. Here's a summary of what we went over. The first two sort of don't really tell you anything by themselves, but when you start getting to the DUI compared to the 10-year median, it tells you whether the market's faster or slower than normal. And then the next 4 columns that are also highlighted in yellow at the top are all current market conditions. They tell you what the market's doing right now. So areas like Santa Teresa, Blossom Valley, North Valley, and Santa Teresa, you can see are basically red across the board, are going to be a pretty hot sellers marketplace. Same with Cupertino, Sunnyvale. And then you have some areas where there's sort of a mixed bag, like Campbell, Willow Glen, Santa Clara. You have 3 out of 4 that are red, and yet sellers are doing a price adjustment in the negative direction. You have to sort of get an overall picture, and 0.3% price reduction is pretty minor. The next 2 columns are highlighted orange because they're lagging indicators. They tell you where the market was 4 to 6 weeks ago. And then the last 2 are basically appreciation, the price range that we talked about. And I don't do a slide because it's the same color as the pricing, but it shows you what the estimated payments would be, principal, interest, taxes, and insurance. So the whole monthly payment, assuming an 80% loan at 30-year fixed at the national average rate. Now we're leaving micro market areas and we're talking about Silicon Valley as a whole. So we take all those 20 micro market areas, put them in a blender. What's the data doing? And your inventory is down here right at 80%. Your offers accepted is right at 80%. So your DUI is shooting up and basically almost at 100%. It looks like it's about 98% of where you'd expect it to be. So 2% faster than typical. This chart is mostly up here for the bottom line. And we have the 24th fewest number of offers accepted in the last 25 years, and the 9th fewest offers accepted out of the last 10. And to make matters even worse, it was the pandemic when we weren't allowed to show properties that only had the lowest. Basically, this is in my opinion, a record low volume of transactions. And, we have probably close to record low inventory. But when you have no volume behind the marketplace, it's much harder to determine the health of the marketplace. And just for those observant people, this is 2023 because I go back to October, and October was 2023. In another 8 weeks, this will be labeled 2024. But for now, we're in the 2023 column, even though you come down to April 19th, and you're clearly in 2024. Here's the estimated payments, and here This is the cheapest 10% for all of Silicon Valley, the typical house in all of Silicon Valley, and the most expensive home in all of Silicon Valley. So we're finally getting payments back up to what they were in the peak of the payment cycle. The peak of the real estate market was back here, you know, somewhere along this rapid increase, and we're having a rapid increase again now, and we're back up to the same high payments that we were back close to 6 months ago. Now we're doing something that's fairly unique as far as I'm aware of, and what we're looking at is the seller price reductions, and it's a distribution. The big takeaway is the dotted dash blue line down here is where the market was a year ago, and the green dash dotted line up here is where we are today. So you can see the market is much hotter than it is today. We're also sort of at a little bit of a plateau right now. You can see the market's improved, but what we do is we step through and we look at a month at a time from 12 months ago, which is a year ago right here on the blue dash dotted line. And then we'll be going down for a while, then we'll turn around and we'll start improving. And when we hit 3 months, we change from monthly data to increments to weekly data increments. So here we go. There's the 10 months, 9 months ago, we were bouncing. Now it's the downward march. There's the bottom. Now we're bouncing at the bottom. Now we're upwards, and we're in the week range. Now 6, 5, 4, 3, 2, 1, 0. You can see that for about the last 4 or 5 weeks, we've been bouncing around with not much change. We're getting in that springtime peak of the marketplace, but you can see that the peak of the marketplace this year is hotter. There's more competition. There's less price reductions than there were a year ago. Now we're looking at the same thing on the buyer overbid. Here, there's a lag time of 4 to 6 weeks ago. So even though the green dash dotted line is at the peak right here, remember that's going back in time 4 to 6 weeks ago. But again, the takeaway is you're significantly higher than the blue dotted dashed line down here, which is where we were a year ago. Buyers are finding the market more competitive. They're overbidding a higher percentage and more frequently. The best year we ever had was up here, which was March 29th of 2022. And if you subtract off 4 weeks from then, you're at the end of February. If you subtract off 6 weeks from then, you're at the middle of February of 2022, which is just about when the peak of the market was, in my opinion. And then the worst year we ever had, or month weekly data that we had, it happened to be November 30th, 2001, right after the World Trade Center. And when I say right after the World Trade Center, the end of November, again, you have that 4 to 6 week lag time. So you're at the end of October, middle of October, and 9/11 happened on September 11th. Everybody froze for a while, and then the nesting urge came in and overpowered the market, and then we took off. So now let's step through and we'll go a month at a time. You can see now we're starting to drift down right there. That's about the bottom, and now you're coming up again in 5 weeks, and there we are today. So you can see that there's clearly an annual cycle that's basically the same in both the frequency of price reductions or the distribution of price reductions and the distribution of overbidding. The overbidding one lags behind by the length of escrows. Now what we're doing is giving you a visual comparison of all of Silicon Valley, the active inventory, compared to where it normally is. And the gray line is where you'd expect it to be. That's the median for the past 10 years. The red line is the 90 percentile, or in the case of inventory, the least, because low inventory is a hot marketplace. So it's the 10 percentile of where you'd expect it to be. And the blue is the most you'd expect, is 90%. So the important thing is where you are relative to these lines. The purple line is the current data, the red, the gray, and the blue is what you'd expect the market to do. And that shows you the huge annual cycle. You get down here every year, you come down to about this level is where you'd expect it to be, which is somewhere around 1,250 listings. And then you go all the way up to some number around 3,100 listings. And then you come back down to 1,250 listings. And that's just your yearly cycle. So where are you vertically between the red and the gray, or between the gray and the blue? In this case, we were very close to the red line just a couple weeks ago, basically 3 weeks ago. and we really pulled away. And just this last week, we've had a pretty significant increase. We're at a time when the market's normally increasing, but the fact that we've moved further away from the red line and closer to the gray line, I don't know what I would estimate, that maybe halfway in between now. That indicates that the market is growing in inventory more rapidly than normal. 1 week doesn't make a trend, but it's something to pay attention to, because if all of a sudden the market gets swamped with inventory, which I'm not expecting to happen, but if it does happen and you have limited number of buyers, this market could cool off pretty rapidly. This is looking at that data compared to typical. So we took that gray line and we stretched it out. We stretched the gray line out completely there. And now you can see that the inventory has been growing. It's grown from 70% of where you'd expect it to be to 80% of where you'd expect it to be. So not a huge increase yet, but you can see the increase this last week. There was the dip down at the end of the holiday, and that's because we had Good Friday, Easter, and Cesar Chavez all on one weekend, and holidays negatively impact real estate. Sellers don't put their house on the market going into the weekend, and buyers don't make offers the week coming out of typically. Now we're doing the same thing on the number of offers. And here, because we've had a lack of offers, we were very close to the blue line, and you have the pandemic dip down here, which we're not having this year. So what the line should really be is probably more curved. If you go back and look historical before the pandemic, you really don't have that huge dip down. It's showing up a little bit, but you have more balanced years. So anyway, the real question is are we pulling away from the blue line going towards the gray line? We are, based on the way the plot really is. But if you got rid of the pandemic year, I think you're really behaving right around the blue line. We have inventory pulling away from the red line and offers not pulling away. Now they may pull away this week because there's a week lag, because inventory comes on during the week and then offers happen as a result of open houses and get reported the next week. And that's the week lag, which is, very well. So what we should see is an increase in offers next week compared to typical. And that's something I'm going to be watching very carefully, because if that happens, that indicates the buyer demand is enough to accept the level of increase. But if all of a sudden the buyer demand doesn't go up as much as the inventory went up, then we may be having a starting of an accumulation of inventory. Here's the offers accepted. And here, the 2 slides ago, when we were looking at the inventory was pulling up. And when you look at offers here, offers are completely flat at 80%. So we want to start paying attention to, does this offers go up next week, or does this stay at 80% and our inventory continue to increase? Those are the kinds of subtleties that you're looking for early indications that the market is changing direction a little bit. Here's your Silicon Valley 10-year data compare for DUI. So DUI was down here. Again, this is the Cesar Chavez holiday weekend, but you've been basically flat somewhere right around here, right around 29 days potentially. And that's between the gray line and the red line, the hot marketplace. But this particular week, we're basically touching that gray line. You're right there. So you're having a completely normal year as far as speed of the marketplace. This is, again, a data point you'd really want to watch for the next week and see if all of a sudden we start going above the gray line, because that indicates the market slowing. Now, don't get me wrong, it's not a collapse of the marketplace or anything like that. And the market is overheated, and the typical Silicon Valley market is overheated. So if we went a little bit above the gray line, that would not be a problem, but it's the shifts that are important. And you can see on how close the purple, the actual data, has followed the typical pattern. And right now we've been a little bit below, so the demand has been a little bit higher than the supply. Here is it compared to the pulling out the gray line, making it straight, and you can see the huge dip down and now an improvement. So this is basically the holiday weekend delayed by a week. And now what we want to do is see if it stays down around 90% here, or if it starts going up to around 100%. Here is the simple data for folks to understand how long does it take 3 out of 4 sellers to sell their property. And right now you're down here at something like 14 days. Clearly 2 weeks to sell a property is very reasonable. It's almost as fast as you'd expect it to be. The step function is one of the reasons I went for the 75th percentile. Apparently, I needed to go more like an 80 or 85 percentile in order to get rid of the step function, because you really can't see if the market's improving here or if it's turned and going up. You want this to be a smooth line and not these stair steps. And that's one of the reasons, one of the drawbacks of the median. The median is almost always a stair step function, and you really don't want that to see that. And you can see the stair step in the red line up coming on the improvement over here. You want a nice gradual slope. Here's the same data compared to the 10-year median. So you can see again the huge slowdown for marketing time for the Cesar Chavez holiday, the Easter Good Friday holiday. And now you're back up there. A little harder to tell where the market's been, but typical would have been a flat line. So you're clearly sort of flat here. Then you had a huge deterioration, a huge improvement, and then another deterioration, but you're still at 80%. So you're still 20% faster than you typically are. Here's the ask price reductions. And on this, it's sort of interesting. You're following the pattern of the gray line. The purple's basically tracing the gray line a little bit below, which means the sellers are taking slightly bigger price reductions. And this is the average price reductions. And you got to pay attention because here's 100%. So that would be no price reduction at all. And this is 1% way down here. So what we're talking about is we're talking about sellers taking a 0.4% price reduction. But again, it's not the magnitude, it's the tracing. How well are you going? And, it's tracing the gray line fairly well. Yes, it's a little bit more price reductions than typical, but it's following it fairly normally. And that's what you're looking for. When the market changes, look back here in 2022, when we had the market correction or collapse, depending on how you want to classify it. And look how rapidly the purple line just went from above the red to below the blue. And I mean, it just dropped. Now it dropped at a time when the market's normally correcting, which makes it harder to see the change. But you're above the red, then you're between the red and the gray, and then all of a sudden you're between the gray and the blue, and then you're equal to the blue, and then here you're below the blue. So it happened pretty quickly, and that's the kind of change you're looking for. Here is an improving marketplace as you're going from the blue to the gray pretty rapidly. And right now you rolled over, but the gray is falling down. So right now I would say it's following the gray pattern pretty typically. And here's that gray line straightened out. And here you can start seeing the collapse in 2022 better, more easily, because you can see the percent change dropping right off. And then you can see little fluctuations here where the market was cooling, then improving, and now it's been basically flat since 49ers got out of the Super Bowl. Nothing against the 49ers being in the Super Bowl, but real estate is an optional event, and be it a holiday or social events like watching your football team in the playoffs, and then in the Super Bowl, it takes people away from the real estate market, and that's why you dip down compared to normal. Here's the sellers taking the largest price reduction. So here, instead of looking at the average price reduction, I changed over and said the vast majority of the sellers take no price reduction whatsoever. So let's just look at the 10% of the sellers that take the largest price reduction. Normal would be up here. Blue is the most price reductions you'd expect. The red is the least. So even, if you're looking at the 10 percentile, even in a super hot marketplace, those 10% are taking a 5% price reduction. They're typically taking something closer to a 7% price reduction. Right now, they're taking something closer to a 9% price reduction. And in a cool marketplace, they're taking something closer to a 12% price reduction. Here's the gray line. It's almost black, unfortunately, but that should be the gray line. The blue line's up here. You can see the sellers were taking less price reductions. Now they're taking a bit more. But basically, no huge change. And here's my 2022 going into the hot marketplace, and then here is the collapse of the marketplace, and it just skyrocketed. Look how quickly that went up and for how long. So in basically in a period of a quarter, you went from sellers taking no price reductions, and this is the sellers that were taking the biggest 10% of the sellers that were taking the biggest price reductions. You went from that being essentially zero to it being, 60% more than normal. Right now, you're only at something like 25% more than normal. Here's the frequency of price reductions. This is basically following the absolute normal pattern. So that's encouraging. It's saying that sellers that are taking price reductions are not doing it any more frequently than normal. If the average is greater and the frequency is normal, that says the sellers that are doing price reductions are taking bigger price reductions. And that's on a percentage basis, because obviously the magnitude of price reductions are going to get bigger as the dollar amounts go up. Here's the seller's Silicon Valley ask price versus typical. So, the sellers are basically right at 100%. You can see, you've been varying from 75% to 100%, a little bit less than normal, back up to a little bit more, and then back to normal. Here's the average overbid. Again, the gray line is where you'd expect the market to be. The overbidding currently is the purple line. So you're approaching not there, but you're at least halfway towards a hot marketplace. And you've been pulling away because here you're vertically pretty close. And now right about right about when the 49ers left the Super Bowl is when the market started to shoot up and pull away from the gray line. Because up till about middle of February, the gray line and the purple line were following roughly the normal pattern, and then all of a sudden the pull away. Here's the gray line pulled out, and you can see we're improving right now. So buyers are overbidding right now. My read on the marketplace is we're probably pretty close to where this is going to level off and may go the other direction. And that's tough to call because in reality, I would expect it to pull off, but it's going to pull off more than it typically pulls off. And that's the real tough question to answer. Here's the frequency. You can see you're following it up, and now you're a little bit higher. So the last couple weeks, you've gotten more overbidding, more frequent overbidding. And on the frequency, it can be a very small amount of overbidding, but it still counts as over. Here is the frequency. So this is the gray line pulled out straight. You can see the purple's about halfway between the red and the gray line. And this red line and this blue line are not the same as on the other graph, the previous. The gray line is, you're looking at 100%, but these percentages change, and that's just getting too complicated. So I just put sort of an arbitrary number of up 10 and down 10%. Here's looking at the price, the long-term appreciation. You can see the end of the year dip down every single year. You can see that we're now above the line, so we have more appreciation than you expect. And this is all of Silicon Valley, so I believe this number is 1,750,000. We're now looking at the three counties individually. This is back to active inventory. Alameda County has the most inventory. Santa Clara is second, and San Mateo County is third. That is the long-term history back here, the order you'd expect them to be in. Here's the offers accepted. Santa Clara is clearly on top, and that is not what you'd expect. If you look to the left of the graph, you'll see that historically, Santa Clara County and Alameda County have been very similar in volume. Here, Santa Clara County is at 1,000, and Alameda County is just over 800. So Santa Clara County is doing almost 25% more sales than Alameda County. And when you look historically, they're very close together. So Santa Clara County is doing its bigger share of the marketplace right now. And San Mateo County is a little bit below where they typically are. All three counties are below where they typically are, but Santa Clara County is doing the best out of the three. Here's your days of unsold inventory. Santa Clara County has the least days of unsold inventory at just about 24 days, it looks like. Alameda County is next at about 33 days. And then San Mateo County is the slowest at about 37 days. And 37 days is still under that 40 days that I consider, or 42 days that I consider to be a seller's marketplace. Time on the marketplace, Santa Clara County being the fastest at 12 days. San Mateo County is falling in second place. So that almost is a little bit of contradiction, but they're different measures. Days on market only includes the properties that have successfully sold, where days of unsold inventory includes the homes that aren't selling. So what this tells me is San Mateo County has some homes that aren't selling, and that's why the days of unsold inventory is higher relative to the days on market. And then you have Alameda County coming in probably at 15 days. And to sell 3/4 of your homes in basically 2 weeks or less is still a hot marketplace. So, just because you're in third place doesn't mean you have a slow marketplace. Here's the magnitude of price reductions. Santa Clara County has the least at 0.4%. San Mateo County is second at just over 0.5%. And Alameda County is third, and it looks like it's about 0.7% price reductions. The frequency of price reductions here, San Mateo County is actually doing the least. Only 5% of the sellers are reducing their price. Santa Clara County is about 7.5%, and Alameda County has 10% of the sellers reducing their price. Here's the magnitude of overbidding. Santa Clara and Alameda County are essentially tied at right about 11. It looks like Santa Clara is at 10.5 and Alameda County is at 11. So even though Alameda County is doing less offers, the buyers are overbidding a little tiny bit more than in Santa Clara, and San Mateo County is down here at about 7% overbid on average. Frequency, again, Santa Clara and Alameda County are tied, with Alameda maybe pulling up a little bit at 80% of the sellers getting more, where Santa Clara could be 79%. San Mateo County is down here at 68%. And when I say down here at 68%, that's still 2/3 of the sellers are getting more than their asking price. Here's the appreciation. Santa Clara County is coming in the best with basically almost 210, it's 208% of where they were. So the more than doubled of where they were in 2015. Alameda County about 190%, and San Mateo County down here at 175%. Look how close together San Mateo County and Santa Clara County are. I believe the numbers were 2,015,000 for San Mateo County and 2 million even for Santa Clara County, and then Alameda County down at something like 1,450. Here's the same information on regular paper. The previous was on logarithmic paper. And here's the estimated payment, the same order. This assumes that 80% loan, PITI. Here's the actual numbers, so you can pick the individual county you want or the whole region. You can pick whatever metric you want and get exact numbers. Now we're leaving the Silicon Valley and looking at the Greater Bay Area, which includes the Silicon Valley as one region, the cities as a second, North Bay as a third, Central Valley as a fourth, and finally the Central Coast as a fifth. Here are the numbers. I'll just point out, yeah, 2 million for Santa Clara County, 2,215,000 for San Mateo, both higher than San Francisco and Marin by quite a bit. Region, Silicon Valley is cheaper because it's pulled down by Alameda County, but the two counties, San Mateo County is now the most expensive county in the Bay Area, followed by Santa Clara, followed by Marin, followed by San Francisco. Here's the 5 regions. You have the Central Coast and the cities down here because they're small regions. The North Bay is the largest level of inventory right now, and the Central Valley and the Silicon Valley are basically tied. Here's looking at number of offers. Silicon Valley has the most number of offers. Here, North Bay and Central Valley are tied for the second and third. Then the cities, and then last place with the least amount of offers is the Central Coast. Speed of the marketplace, Silicon Valley is the fastest, Central Coast is the slowest. The other 3 are pretty close together in the middle. Days on market, Central Coast is the slowest, Silicon Valley is the fastest. The other 3 are somewhat close together, but you can see here North Bay now is slowed down, and I would say cities and the Central Valley are pretty close together. But all 5 regions are still selling their home in less than 6 weeks. 3 out of the 5 regions are selling in under 4 weeks, and Silicon Valley is the only one selling in 2 weeks. Those are still very respectful marketing times. Price reductions, these are the seller's price reductions to get the offer in. Silicon Valley has the least, followed by the Central Valley, and then you've got a basically close to a 3-way tie between North Bay, the cities, and the Central Coast. The frequency of price reductions, Silicon Valley the least, followed by the cities, Central Coast, then the North Bay, and taking the most price reductions is the Central Valley. The magnitude of overbidding, Silicon Valley, followed by the cities, followed by the North Bay, followed by the Central Valley, and the Central Coast has the least amount of overbidding. Frequency, Silicon Valley, the cities, North Bay, Central Valley, and the Central Coast. Central Coast really doesn't have much of an economic job center, and that could be why their market is sort of more laid back than the Silicon Valley and Central Valley cities areas. Here's the appreciation. Silicon Valley has the most appreciation, followed by the Central Valley. Central Valley, I think, has come up because it was an affordable thing, and with the pandemic, You can go back and see how all areas are really close. The real takeaway, in my opinion, is look at the cities. You know, it was right there in the middle until basically the pandemic, and then it dropped to the bottom. And right now it's only at 50%. So in the cities, you got 50% appreciation. And in Silicon Valley, you have slightly over 100% appreciation. So you would have doubled your appreciation rate if you bought in Silicon Valley versus Marin or San Francisco. Here are the median prices. The Silicon Valley and the cities are very close together. Central Coast is in the middle, then the North Bay, and the most affordable area, which is why the appreciation I think is there, is the Central Valley. Here's the monthly payments in the same order. And what we've been talking about is week number 16 of Silicon Valley. You can type in either the YouTube blue URL to get to the archives or the shorter green root URL. If you add 2024 to the green root URL, you get the live presentation Saturday morning. If you add in H, the year, month, and day, you get the handout, and it is posted, and you can get to any specific episode. I'm Richard Calhoun, Creekside Realty, working with buyers or sellers. Open for any questions. Let me see if anyone's got an unmuted mic. No unmuted mics. So what I'll do is flip on to the next slide. This has been a presentation of Silicon Valley real estate market geographically of single family homes. It's the most current. Basically the data's through Thursday morning and it's presented on Saturday. That's pretty fast turnaround. It's the most comprehensive. There's so many different metrics. I don't know if anybody that offers more. In fact, if anybody knows of another metric I should be following, I'd be happy to look into it. And I also correct the data. There's a lot of data entry errors and a lot of duplicate listings on more than one MLS, and I delete those. I search and do a pretty good job of getting them all. I may miss one or two, but I am deleting almost that I can find. I use a 5-week period because I believe real estate has a huge weekly cycle caused by weekend showings versus most people look at report calendar month dates. Calendar months are also important because you have months like February that have 28 days, and then you have other months that have 31, but they also have different number of weekends and weekdays, which has a huge impact, and that varies from year to year. By using a 5-week median, I'm comparing the same week all the time, and my year, because of leap year, starts on March 1st, and then I look backwards. So I go from March 1st, I jump forward 7 days at a time. When I get around to February 21st, I jump forward 8 days back to March 1st. Except in leap years, I jump forward 9 days, and that gets rid of the fact that we don't have an even number of weeks. I look at offers accepted versus pending. The problem with looking at pending transactions, which most of the other people that analyze the marketplace do, is if you're in escrow for a longer period of time because you're having buyers having a hard time getting the loan, that particular transaction impacts the statistics for a longer period of time than the offer that comes in with cash and closes in 1 or 2 weeks. I look at 20 micro market areas, and that's what I start the presentation off with. I then look at the combined Silicon Valley. I then come back and look at the 3 counties individually, and those 3 counties are Santa Clara County, San Mateo, and Alameda Counties. I then move on to the Greater Bay Area, made up of 5 regions, which include 13 counties here in Northern California. I look at the supply, the demand, and the balance compared to their 10-year medians. So you have an idea of whether you have more or less inventory for that period of time. I then look at the current supply-demand ratio. That's the speed of the marketplace you're going to see right now. On days on market, time to sell, I look at not the median and average as most people do. The average has a drawback of when one seller that was on the market for a long time sells, after a year or two, he really brings up that average. And the median has a problem because it's so low. There's a lot of step functions. So I have taken on the 3/4, the 75th percentile, and reported what that person's doing. It gives you a very sensitive measure that moves up and down almost all the time smoothly. However, when you do get a very fast marketplace, you do get the step function that I try to get away from. I look at the seller's expectations versus market conditions, and I measure that by looking at the frequency and magnitude of price reductions. I then look at the buyer competition, and I look at that again by the overbidding frequency, magnitude, and frequency of overbidding. I then look at the appreciation since 2015. I elected to go with a 9-month period of time because I wanted stable market. And one of the things you quickly learn about Silicon Valley is the first 3 months of the year is when you see some pretty radical price changes. And therefore, I eliminated that by looking at just the last 9 months. I picked 2015 because it was back in time and it was fairly stable in pricing. I look at the low, typical, and high price instead of just the median. So you have a sandwich effect. You know what the total price range is. And then I bring in the total monthly payment, including PITI, principal, taxes, and insurance. And I'm assuming an 80% loan and a 30-year fixed rate loan using the national average. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers and sellers here in Silicon Valley since 1981. Happy to reach out and talk to anybody that wants to discuss real estate. Thanks. Have a great week. Bye for now.